advisor that works mostly with retirees or people that are about to retire, I think some of the best educational opportunities are actual, client anecdotes. These are, situations that, I actually see in, just daily interactions with clients. One interaction I had recently with a client was specifically in regards to charitable gifting. So I just want to give you some thoughts on a couple different ways that you can gift to charities as a retiree for a variety of reasons. So I actually run a tax report for my clients every year. They give me a copy of their tax return. I run a tax report and we look at all the numbers, just to look for opportunities, things like that. And the tax return really tells you a lot of good information. So I just want to show you this example. This particular client, this is kind of their last year of working, so they had a lot of income, but going forward, income will definitely be lower. One thing I noticed about this return is they do not itemize deductions. And so, you can see there, this is for 2023. Their standard deduction was $27,700 for a married filing jointly couple. And so I can see there that, they don't itemize. So just as a recap, to be able to itemize your deductions, you have to have a lot of different things going on. You either have to have some serious, medical expenses that are not covered by insurance. Property tax, of course, that's capped, currently at $10,000. You have, if you had a mortgage, mortgage interest, and then also charitable donations. And to be able to itemize deductions, all those things have to total something greater than the standard deduction. So the standard deduction in recent years has become quite high. So I'd say most people don't itemize deductions. Most people take that standard deduction. So in reviewing this particular tax return, I noticed that they take the standard deduction. They don't itemize. So if this particular couple wrote a check to a charity, they don't really get any benefit out of it, right? Unless it's a massive check to a charity. But just, I send $100 to XYZ charity, they get the money, that's great, but I don't get anything out of it because I take the standard deduction. I can't itemize. So this was an interesting case. This particular couple is looking to, they're going to have lower income, within the next several years, early 60s, not going to have to take RMDs from the IRAs until age 73 or 75. And they want to do some heavy duty Roth conversions, over the next several years while their income is relatively low. So, obviously if you're doing Roth conversions, and I've done another video on that, that does generate taxable income. So they could really use some tax deductions, right? And so their CPA had suggested to them they should consider opening a private foundation. And so very expensive startup cost. I think the startup they got quoted was like $30,000 to pay to an attorney to set up this foundation. And the idea was they put all this money in the foundation and they basically used it kind of as a jobs program for them and made possibly their family members in retirement. And so they could earn some salaries and also give money away. So I was talking to them about the difference between a private foundation and what's called a donor advised fund. And so I'm not here to say one's better than the other. I have a lot of experience with both, and I particularly donor advised funds. And so I just want to share a couple of pros and cons to that. But first of all, if they established a private foundation, there's some big requirements, and you're basically creating your own charity. And so there's a 5% rule. You have to at least give away 5% of the income, of the portfolio every year away. And so that needs to be done. There's a separate tax return that needs to be filed. They have to do actual board meetings and record the minutes and all that stuff. So are some serious requirements in order to keep that as a charity status, right? And so there are definitely some advantages, but I brought up the concept of a donor advised fund. The best way to describe this is to I create a couple slides for it, is a donor advised fund. You have your own giving account or donor advised fund account. A number of brokerages offer this, like your Schwab's, Fidelity, Vanguard, most big brokerages will offer something like this. And so anyway, you have your donor advised fund account, let's call it your account. That account is a charity. Okay, and so what I could do, I could donate cash to it. I could donate appreciated stock, mutual funds. I could even put real estate into it if I wanted to. And so that account is a charity. So what happens when I do that, I get a tax deduction for that potentially when I donate the securities in there. Ideally, if you had some appreciated stocks, not in a retirement account, but in a brokerage account, I had some appreciated securities, I could donate that into my donor advised fund account, and then I'm giving away those capital gains as well as getting a tax deduction. So you don't pay tax on those gains. Your donor advised fund account is a charity. Remember that, and so I get a deduction for that in that current year. So maybe a good way to think about this is I want to do some heavy duty Roth conversions over the next several years. So every year, why don't I kind of concentrate the amount of money I want to give away for the foreseeable future, possibly in the rest of my life, in those years, maybe a little bit every year or a lot every year, and I get a big tax deduction each one of those years. Okay, the way a donor advised fund works is that I basically will put stocks, bonds, cash. That's what most people donate. You could donate a piece of property, and so that goes into my donor advised fund. Okay, and so I get a tax deduction in that particular year. So the donor advised fund will take that, they'll immediately liquidate it. You get a deduction of for the fair market value of those securities on the day you donated it. So, and now it's in the charity, right? And typically you can invest those funds. It's in your donor advised fund account, and there's probably some prepackaged mutual funds or something like that you can invest in, and it could actually grow, while it's in this donor advised fund. And so what happens then, just like the name implies, donor advised fund, you get to call the shots where that money goes to. There may be some limitations on that, but most, 501c3s or public charities you can donate money to. And so once it's in your account, you can decide when you want to give that money away. There's no 5% rule like a foundation. You can dole that money out to charities anytime you want, whenever you want. Hey, I want to send $100 to XYZ charity. I want to send $1,000 to ABC charity. It's completely up to you where that money goes. And you can name, legacy charities. If I die, this is where the money's going to go. It's very, very flexible. And so, once you give them securities into your account, obviously that's an irrevocable gift and you can't change that. But you can always send the money wherever you want. You can even do anonymous gifts. So that's kind of a cool thing too. If I said, hey, I don't want to get 50 pounds of mail for the next year, but I do want to support this charity, I can donate anonymously. So that's a really great thing you can do as well. So I just wanted to show you, there's a couple of differences between a donor advised fund and a private foundation. So number one, you can support charities. That's the whole purpose of this. The account could grow. In a foundation, it's like a brokerage account. You could basically invest in securities, maybe a little bit more limited. In a donor advised fund, it's usually mutual funds or index funds, whatever, and you can choose whatever you want. You can donate non-cash items, like I mentioned, like real estate, things like that. So you'll notice that the deductions are a little bit different depending on if it's a donor advised fund or a foundation. So maybe or maybe not advantages for one versus the other. A donor advised fund, it's 60% deduction for cash. And so if you're donating cash, you can basically, it's 60% of your AGI, your adjusted gross income. And we looked at it on that first slide when we did the tax report for the client. We know what that is because we've seen the tax return. It's a 60% deduction. A private foundation, it's only 30%. So a cash donation, it's only deductible up to 30% of their adjusted gross income. So it may or may not be an advantage. For securities, like a stock that's appreciated or a mutual fund, it's 30% deduction for donor advised fund, 20% for private foundations. As far as tax goes, a donor advised fund, there is no tax. I mean, once you donate those securities, you're done. I mean, there's no tax to you. Private foundation, that's not the case. You actually have some tax on, if it generates investment income. That's kind of surprising to a lot. You can donate anonymously to a donor advised fund. You cannot do that with a private foundation. I believe, I don't know the reasoning behind that, but I guess the IRS wants to know where money's coming from, if you're supporting a charity from a foundation. You can name successors, all that stuff. But I just think, with a donor advised fund, there's no startup costs like there would. You don't have to go to an attorney to set it up. You just set up an account online and you start donating to it. But I just really like it. If you want a a big deduction now, but I don't want to give all that money to a charity right away. I want to be able to dole it out, kind of over time. I think a donor advised fund is a really good idea. And so for this particular couple I was talking about, they want to do some big Roth conversions the next several years, so they want to lower their taxable income. So the suggestion would be, hey, let's concentrate charitable donations that you want to make, and let's do that over the next several years, get some big tax deductions, and that will just help lower that taxable income while they're converting to a Roth. I think it's a great idea. And so, as for the private foundation, the CPA, I usually will say in all my videos, hey, listen to your CPA. And I told this client the same thing. I'm not a tax advisor. I'm a financial planner. I'm a certified financial planner, but I'm not a CPA. I'm not signing their tax return. So, listen to your CPA. But I just thought, if it's really for a jobs program, to collect a salary, that, the foundation, the whole reason that it's tax free or, considered a charity is because the purpose of it is to give money away. Let's say I gave away $50,000 one year out of my private foundation, and I'm also paying salaries to me and my family members for $50,000. Well, you're basically saying that the administration costs are equal to the amount of money we're giving away every year. That might raise some red flags. I don't know how that works, but I'm just saying in my little mind, that might raise some red flags. So anyway, I wanted this client to look at the concept of a donor advised fund because I really think it's a good idea. It's very flexible. I can give money away into my donor advised fund account, and I can dole it out to charities as I see fit. Anyway, that's the long and short of it. So if you have any questions, please reach out to me directly. My contact information is in the About section of my YouTube channel. And once again, thanks for watching my video.